One of the biggest partners in your retirement plan is someone you probably never invited, the IRS. Now, that might sound like a strange way to start a conversation about retirement planning, but if you have money in a traditional IRA, 401k, 403b, or any other tax-deferred retirement account, the government already has a claim on part of that money. In fact, if someone retires with $1 million in one of those accounts, the reality is it may not truly be $1 million because every dollar a traditional retirement account still has taxes attached to it. And depending on future tax rates, required minimum distributions, and how retirement income unfolds, the tax bill could end up being much larger than many retirees ever expected. And that's exactly why one topic has suddenly become one of the most important conversations in retirement planning today: Roth conversions. We've done several videos over this, but over the past several years, more financial professionals, tax planners, and retirement planning specialists have started focusing on this strategy for one simple reason. It gives retirees a way to potentially take more control over their financial future and taxes. In this video, we're going to walk through three important things. First, we'll look at why retirement taxes may become a much bigger issue for retirees than many people realize. Second, we'll talk about what Roth conversions actually are and how they work in simple terms. And then third, I'll show you a simple way to see whether this strategy might make sense for your own situation using a tool we created that can help visualize the impact. Because retirement planning isn't just in savings. It's about understanding how much of those savings you actually get to keep. Now, let's talk about the retirement tax surprise. For decades, the main retirement strategy most people were taught looked something like this: put money into your 401k, contribute to an IRA, get a tax deduction today, let money grow, defer, and worry about taxes later. That approach became incredibly popular for a simple reason. It worked very well during the working years. Every time you contributed money to a tax-deferred retirement account, you lowered your taxable income. That meant you paid less in taxes today. And for many people, that felt like an obvious win. But there was always one important detail in the background. The taxes were never eliminated. They were simply just postponed. Every dollar that goes into a traditional retirement account eventually comes out as taxable income. Not just the growth, not just part of the balance, but every dollar will be taxable. And when you begin withdrawing that money in retirement, the IRS collects its share. For some retirees, that may not be a major issue. But for others, especially those who have built large tax-deferred accounts over many years, that tax impact later in retirement can become surprisingly large. So why is this issue getting bigger? Well, today, several trends are converging that make taxes a much more important part of retirement planning than they used to. Let's walk through a few of them. One, larger retirement accounts. Over the past several decades, retirement accounts have grown dramatically. Employer plans expanded, contribution limits increased, rollovers became more common, and millions of Americans spent decades into a tax-deferred account. That means many retirees are now entering retirement with balances that previous generations rarely had. Now, seven-figure retirement accounts are no longer unusual. And while that sounds like great news, it also means those accounts may carry very large future tax obligations. Because remember, every dollar coming out of those accounts is treated as ordinary income. The other trend that we see is required minimum distributions. Another factor many retirees don't fully anticipate is something that's called the required minimum distribution. Now, some of us just call it simply an RMD. Once you reach a certain age, the IRS requires you to begin withdrawing money from that traditional retirement account, whether you need that money or income or not. Now, today, that age is generally 73, and it will be eventually 75. And each year, that withdrawal percentage increases, which means the IRS eventually forces money out of those accounts and onto your tax return. For retirees with large balances, those required minimum withdrawals can be surprisingly large. And when those withdrawals occur, they add to your taxable income for the year. That's where the tax picture can start to change quickly. The other trend that we see is that income is starting to stack. Another factor that surprises many retirees is how retirement income tends to stack together. Now, imagine someone in their 70s. They might have Social Security income, required minimum distributions, maybe they have some investment income, maybe a pension, and possibly some capital gains. All those income streams combine together on a tax return. And when they do, they can push retirees into higher tax brackets than they ever expected to reach, which means more of their retirement income may be taxed at higher rates. Trend 4 is that there's some future tax uncertainty. And the bigger question that no one can really answer is, what are future tax rates going to be? The United States currently carries one of the largest national debts in history. And historically, governments facing large debt obligations eventually raise revenue in some form. Now, no one knows exactly what future tax laws will look like. But many retirees are beginning to recognize that locking in today's tax rates may be more appealing than leaving everything exposed to unknown future changes. This is one of the biggest reasons Roth conversions have become such a widely discussed strategy. So what is the Roth conversion concept? What exactly is this? At its core, it's very simple. A Roth conversion means moving money from a traditional retirement account into a Roth account. For example, a traditional IRA to a Roth IRA, when you make that move, you voluntarily are paying the taxes on the amount converting during that year. In other words, you're choosing to recognize that income today. But once the money moves into the Roth account, something very powerful happens. From that point forward, the money can grow tax-free. Future withdrawals may be tax-free, and Roth IRAs are not subject to required minimum distributions during the owner's lifetime. That means that IRS no longer can force you to take those withdrawals. Essentially, you've converted money that was once taxable in the future into money that may now live in a tax-free environment. So why do people do Roth conversions? Now, the goal of a Roth conversion is not simply to pay taxes sooner. The goal is to potentially pay taxes at a lower rate than you might pay later. Think of it as managing taxes across your lifetime rather than just to them each year. For some retirees, that means gradually converting portions of your retirement accounts during years when their tax bracket is lower. That way, they avoid being pushed into higher brackets later because distributions or some other income could force them to a higher bracket. Now, let's talk about the retirement tax valley. One of the most interesting opportunities for Roth conversions often appears during periods sometimes called as the retirement tax valley. This period typically occurs between two events: the moment someone stops working and the moment required minimum distributions begin. During this window, something unusual often happens. Income temporarily drops, the paycheck disappears, but Social Security might not have started, and required minimum distributions haven't begun, which means taxable income during those years may be lower than it will be later in retirement. For many retirees, that creates a window where they may be able to convert portions of their retirement savings into a Roth account while staying within a relatively favorable tax bracket. Now, instead of waiting until later, when larger mandatory withdrawals push their income higher, this would be a better way. Now, let me give you a simple example. Let's look at someone who retired at age 62 with a large traditional IRA. They decide to delay Social Security until age 70, and the required minimum distributions won't until age 73. Between 62 and 70, we know that their taxable income is going to be relatively low. During those years, we've now created an opportunity where they could gradually convert portions of the retirement accounts to a Roth IRA. Each conversion would be taxable in the year that they make that conversion. But if done carefully, those conversions could occur while staying within a moderate tax bracket that they want to move at. Now, over time, that may shift a meaningful portion of their retirement savings, especially their tax-deferred retirement accounts, into an account that grows tax-free and is no longer subject to required minimum distributions. Now, that could reduce the taxes later in retirement. It also reduces, you still have to take income from the Roth IRA. It's not going to count as income when we're looking at your overall tax structure. Now, Roth conversions are not a one-size-fits-all, and it's important to understand something here. Roth conversions are not automatically the right strategy for everyone. In some cases, they may not make sense at all. For example, someone who expects to be in a much lower tax bracket later in life may benefit from leaving money in tax-deferred accounts. Others may not want to accelerate taxes today, and sometimes the tax impact of a large conversion can be significant if it pushes someone into higher brackets. This is exactly why Roth conversions need to be evaluated carefully, which brings us to an important question many people ask. The question people learn about Roth conversions: how do I know if this would actually help me. How do I know if Roth conversions would actually benefit our situation? Because every retirement plan is different. We have different ages, different income sources, different account balances, different tax brackets, and trying to estimate the long-term tax impact of Roth conversions manually can be pretty difficult. So you have to consider, what are your future requirements be? What's it look like? What tax bracket thresholds are? What investment growth will you have? What kind of withdrawal timing do you have? It quickly becomes a complex puzzle, which is exactly why we decided to create a simple tool. Now, this tool is free, so you can go to it. You can go to privatewealthlearning.com, and I'll show it to you in just a second. But if you go there, I'll put the link in the description below. And now, if you do go there, before you, make sure you hit that subscribe button. I would appreciate it. So, over time, we had a lot of people asking the same question. Can I quickly just see if a Roth conversion makes sense, or see whether Roth conversions might make sense for my situation? So we built this simple tool designed to help answer that question. The idea behind the tool is straightforward. You enter details about your retirement picture. Now, we're not going to go into a deep dive for this calculator. This is just to give you an idea. Does it make sense for you to continue on the path of should you look at doing Roth conversions or not? We're going to ask things like, what's your age? What kind of income do you have? What kind of account balance do you have? And then what type of growth do you expect? Lastly, we're going to ask, what type of bracket do you want to be in? Do you want to move money at? And this will compare different scenarios. You can look to see how much money you will in retirement. And when you see these two paths side by side, they'll help you reveal something many people never visualized before. It'll help you understand the long-term tax impact of your retirement withdrawals. Sometimes the difference could be small, but in other cases, the impact can be surprisingly meaningful. And simply seeing the comparison can help people make that much more informed decision. So one of the hardest parts of retirement is that many decisions have long-term consequences that aren't obvious today. And that's why the visualize matters. And that's why we this tool. Now, taxes are a perfect example. A strategy that looks fine this year might create a large tax spike later. But without projecting those future scenarios, it can be very difficult to see that coming. Tools that visualize retirement income and taxes over time can help bring clarity to those decisions. Not to make decisions for you, but to help you understand the possible outcomes. So the bigger picture, at the end of the day, Roth conversions are simply one tool among many in retirement planning. They're not magic, they're not required, and they're not always the best choice, but in the right circumstances, they can be a valuable strategy for managing your future taxes. And as retirement accounts continue growing larger and tax uncertainty remains part of the conversation, more retirees are starting to explore this option. Because the goal isn't just to build wealth, the goal is to structure retirement income in a way that allows you to keep more of what you've worked so hard to save. So what I'm going to do is I'm going to show you quickly. When you go to privatewealthlearning.com, you can click this button where it says start calculating, and you can start putting in your information and then click compare scenarios. You can choose between different brackets that you might want to convert at, and it'll tell you how much money you might potentially save. It's worth it a shot. There's no cost to it. Just go to privatewealthlearning.com. Now, if you're curious about whether Roth conversions might make sense for your own retirement plan, I created that privatewealthlearning.com site. That way you can explore that question. You can try the Roth conversion analysis by clicking that link below. It only takes a few minutes to enter the basic details and see how different strategies might affect your future tax picture. Even if conversions aren't the right fit for your situation, the exercise can still provide insight into how taxes may impact your retirement income over time. Retirement planning isn't just about how much you save, it's about how clearly you understand the road ahead. And sometimes a little clarity can make a big difference in the decisions you make today. I'll see you in the next video.